Rob's with us this afternoon to talk to us some more about finance. And we were just saying how Karen was asking some questions around properties. We were talking about valuations before and a whole range of different things. It's a bit tough, isn't it, Rob, at the minute?
Definitely, yeah. Credit policy is definitely a lot tighter at the moment. I don't find, at the moment, I'm finding there's very few loans that go through without people reducing or consolidating credit card and car loan debt. Because it's just so darn tight, it seems to be about the only way to get it through.
It comes back to that whole, which we've been chatting about all show, housing affordability, because it's the same thing. It's just a different way to look at it.
And the default living expenses the lenders are using are just crazy in some situations.
But Rob's going to talk to us today about something else that people never understand, even when they're going for a loan, which is business structures.
That's right. So, look, I thought it'd be worth looking at this, and it's something I come across quite regularly, I suppose, with people, and often, in my opinion, clients have the wrong business structures. You know, and they're paying way too much tax, or the way it's been submitted by their accountant, it doesn't really help them from a lending perspective.
Or they don't know what their business structure is.
No, most people don't really understand it, and that's happened many times where the client says, I don't know, the accountant told me to set this up, and that's the structure they've got. So I thought I'd talk it through. There's essentially 4 different types of business structures: sole trader, partnership, company, and trust. There's different types of trusts. Most common will be a family trust or a unit trust. Sole trader is just the simplest of all. It's the one that a small business with low volumes and low profit would use, least expensive to set up, and the income's distributed to that business owner. So that's quite simple in that way. So its advantage is its simplicity. For a partnership, it's much like a sole trader, except you've got more than one person, so multiple people. And again, the income of the business is distributed to those partners according to the portion they've decided on. Company's a little more complicated in that it's owned essentially by shareholders, and there has to be directors of that company. It potentially lowers the tax liability because the company tax rate's a little bit lower. The company's treated as a separate entity, so it kind of separates the individuals from the business. In company law, I think when I was doing that, they talked about a company as having a corporate soul. Is that term still used? Because that was about 35 years ago.
I think we've gone away from the word soul with anything to do with companies.
I remember that.
What we call it is, what we say is that you have a veil of incorporation.
Yeah,
so the court doesn't look behind that to see who the individuals are. The company is responsible for company.
Yep.
So it's a natural person.
So it's a separate entity of its own. So it separates the business from the individuals.
It's like having Artie in the room.
Yeah. So that's its advantage, but the disadvantage would be that it costs you more to set up and more to maintain. Family trust is generally with families, and you have discretion as to how you distribute the income. So all the income has to be distributed, and there has to be a trustee. The trustee can be an individual, or it can be a company as well. And again, it can be expensive to set up, but it can be a great way to manage your tax liability. So they're just an overview of the advantages and disadvantages of those different entities.
I think it's really important for people to understand too that when you're in any one of those structures outside of kind of like a basic sole trader, that from a lending point of view, you're actually responsible for the debt.
Yes, that's exactly right.
You know, and so the bank are not going to want to just see your dodgy pay slip that you draw yourself up each week to say that's what I'm drawing. They actually want to go through full financials.
Absolutely. And for an individual and partnership, you are responsible for your liabilities. I actually had a legal person, solicitor, client the other day who was trying to argue, even though it was a sole trader, that the debts belong to the business.
No, there is no business.
And as a sole trader, no, if they're in your name, they're your debts.
Yeah.
So that's kind of how it is.
Same in a partnership. People don't realise that you're actually liable for the entire debts of the partnership, not just your percentage.
In the individual name, so you can't separate your debts from the business.
But even if you're a company structure and the company has liabilities and...
You don't as a director.
Well, what tends to happen is there's usually I don't think there's a lender. Generally, a lender will not lend unless there's a director guarantee. So,
That's right.
So while in theory, the debts of the company are the companies, not the individuals, generally there's a director's guarantee, so they end up being responsible for them.
Yeah.
So
because if the company doesn't meet its liabilities, then the
right.
director is
Yeah.
responsible, and therefore it has to be
So it's
taken into account.
pretty hard to
Yeah, but
escape
that's
that.
only if there is a guarantee.
Only if there's a guarantee. And that would be, there wouldn't be a bank that would lend without a director's guarantee, but you might have other types of loans, informal
Definitely.
loans or creditors, where you might have a supplier who's providing credit. There may not be a director's liability, a director's guarantee with that. But I want to talk about this from the lending perspective too, because, or from a tax and a lending perspective, because this is where the differences really come in. From a lending perspective, sole traders, partnerships are pretty much the same, and also the way they get taxed. So whatever the income of the business is your income. That's what you're going to be taxed on. It's distributed to the business owner, either as the individual or the partner. And also that's the figure that the bank's going to use to assess the loan, and it will appear on your tax return. We don't really care what you've made this year, but it's what you made last year. It's historical. In a company, it's a little different, and that's where it gets a little more complicated. A company, when it comes to what's taxed, it's what's distributed to you firstly. So that might be what by way of salary or director's fee. That goes into your individual tax return. You pay individual tax on that, and then the company pays company tax, and that may be, I think it's at 27% at the moment.
Yep.
27 cents in the dollar, and coming down to about 25 cents in the dollar. So a company structure can save you a lot in tax. It's actually come up a lot. I look carefully. I see a lot of tax returns. I have a lot of self-employed clients. I'll always look at what's going on, and often I'll send clients back to their accountants to talk about different structures.
I do exactly the same when they come in for a
all
legal
the time.
review.
And, just recently I had a sole trader earning, it was about $280,000 a year. He has a wife and small children, and he was paying a truckload of cash, of tax. Sent him back to his accountant, and I've done this many times, and usually the accountant, and I send them back to their accountant. I'll always do that. I don't want to undermine that relationship. And it happened in this occasion, as has been the case in many other occasions, where the accountant says, no, there's nothing wrong with your structure. And I just think, you've got to be kidding. And I asked them then, would you like a second opinion? Because I'm not authorised to give tax advice, even though I understand it. So, and they say yes, because I tell them, I think you can save a lot of tax. So that guy's now switched to a trust structure.
Yep.
And has saved, it's a truckload, like it's something like $60,000 a year in tax.
Yeah.
Which is a whole wage.
Well,
it's,
and I
massive.
find it all the time, particularly when it's husband and wife, and they've set up as a partnership.
Same deal.
And
clients with a partnership as well.
I
Same experience.
Why are you in a partnership? And secondly, what happens if one of you drop dead? Because that's the end of the partnership. And they know none of this.
The big key here is what we're all talking about all the time on this show, is about reviewing stuff, isn't it? Because
and getting the right advice,
Yeah, because you may have started out as a, an arborist that just kind of did the odd tree lopping here and there, and then you've been really good at that. And so you've got more customers and more clients and you've generated more income. And just because that's how you started out doesn't necessarily mean how you continue into the future. So that reviewing
and I think that review's very important, because it's a sole trader or partnership's appropriate for small volumes, low profit, because you don't have to get too creative about it. But if the business starts to grow, you need another structure. And whether that's a company or a trust. The difference with a trust, the way it's taxed, is that there's beneficiaries of the trust, and so the income or the profit of the business is distributed to the beneficiaries, and the beneficiaries pay tax on it. But in a family situation, you can, I had an adult daughter studying, and I allocated income to her. I didn't give her the income. We're paying for a lot of her expenses, but and I paid the tax on it, but I was paying it at a lower marginal tax rate. So there's creative ways that you can use within a family trust to minimise your tax liability. And then if you run out of beneficiaries, you can actually distribute it back into your company. If your company is a trustee, and then only pay company tax on it. So I guess what I'm saying is there's creative ways that you can use to manage your tax liability and to minimise it. But the other thing with these structures to think about and to be aware of when it comes to a lending perspective is the way the lender assesses income. So it's what ends up in your tax return is what the lender's going to use, excluding dividends. So if it's company dividends, lender will not look at that. So it's what you pay yourself as a salary or as a director's fee. That's what the lender's going to use. So if you have a family trust, and I remember one year I distributed about $50,000 to my daughter, and when I was going to say she paid tax on it, but I paid it for her because it was my money anyway. I'm not able to use that income.
No.
It didn't appear in my tax return. The lender will ignore it. I can argue I have discretion, but they're still not going to use it. No. So you've got to be aware of that if you do that. And the other thing too with company profits, lenders treat that differently too. So some will use company profits, but they'll probably only use 80% of that income. Some lenders will allow you to not use the company profits, but not include the liabilities. Some will. So there's a whole lot of variations there. And I think that's where mortgage brokers come in and trying to work out how that's going to work out best for you. And that's something we can work through with accountants as well.
Because you can also have loans to your company as well.
That's right.
So one of my clients didn't realise that all the money that they put in to get it going, which was their own money from their home loan, could actually be deductible
That's
and
right.
also on the books as a loan.
So you need to have a loan agreement between the individuals and that entity, whether it be a trust or a company.
And then it's also considered a liability, a true liability.
That's right.
But at least it's on the books then for
and
the money you've put in.
The tax deduction.
Because there's two real prongs, isn't there, Rob? It's about, being self-employed, you look to save tax where you can. That's a perk of being self-employed. But on the flip side of things, the more you try and save tax means the less available income there is for you to actually
lessen
use
what
to
you
borrow.
report and then what's available. And I guess, look, what I recommend is professionals working together and getting the right advice for our clients. And so I'll often say to clients, with this, what structure is right for you? Get the advice. Talk to your accountant, solicitor, and mortgage broker. Get the right advice. And when it comes to lodging a tax return, I'll often say to clients, look, it depends. The accountant's working on minimising tax.
Yeah.
I want to maximise lending.
Yeah.
So let the accountant send me the draft and we'll have a conversation about it and make sure it's right. Because in some cases, there's a bit of a tweak that we can do, and maybe it's increasing the director's fee or whatever it might be, so that it's going to help the borrowing capacity. Or it might even be, in some cases, declaring cash income. So
You've said things that
so
people...
I think it's time to go.
Oh, I think on that note...
Well, we're on national radio, Rob.
So and why not? Because you can't have your cake and eat it too. So tradies sometimes have to declare their cash income.
That's exactly right.
And it helps them get the loan they're after.
Good advice, as always, Rob. Thank you so much. If someone wanted to chat further, and it sounds like you're very knowledgeable in that space, they can find you down
Give
at
us
Blaxland.
a call. Yeah, Blaxland office is my home office, 4739 9749.
I like your home office. It's actually not where Rob lives. It's actually just where he's
He does
spends
really.
time.
Yeah, the home office of the three that we have. Yeah, that's right.
And he'll be the saviour of your finances.
That's it.
That's putting too many expectations on me.
Well, it's been a great show. Thanks, everybody, for joining in.